Here are some of the big stories the Financial Times will be watching in the week ahead. Zimbabwe goes to the polls for the first time since Robert Mugabe was ousted as president. US non-farm payrolls. Can the American labour market maintain its momentum? And 4 of the big UK banks report results. But is the sector heading for trouble? And the Bank of England is expected to raise interest rates to the highest level since the financial crisis. First, Zimbabwe, which goes to the polls on Monday in the first presidential election since Robert Mugabe was ousted in a coup. The Southern African nation was once a regional exporter, but after years of economic chaos, it's now blighted by rampant poverty and unemployment. Lots of people are cautiously hoping this election will be the catalyst for the beginnings of an economic revival. And the country's ability to hold a peaceful election will be critical to whether donors and investors return to the country.
And Monday's vote will be historic for the Southern African nation, not just because it will be the first since Robert Mugabe, the country's post-independence ruler of 37 years, was deposed in a military coup last year. It's seen as a chance to begin again after years of economic mismanagement and international isolation. The vote pits Emmerson Mnangagwa, Mr. Mugabe's successor, against the young Nelson Chamisa of the main opposition movement for democratic change. The big question will be whether Mr. Mnangagwa and the army commanders who put him in power will allow a free and fair election.
Now, the robustness of the US economy and the strength of its labour market are expected to be confirmed when non-farm payroll numbers for July are released on Friday. The jobs report for June provided a pleasing distraction for investors who spent weeks tracking the twists and the turns of the trade dispute between the US and China. But some question whether the labour market can maintain such a rapid pace with its shrinking pool of skilled workers. The US has added jobs every month for more than 7 years, but analysts have warned that worsening trade disputes could threaten growth, while rising borrowing costs might dampen economic activity. And now to the UK, where 4 of the big banks report results this week. They're expected to boast of rising profits and promise increased payouts to shareholders. Solid economic growth in Asia is expected to boost Standard Chartered's revenues by close to 10%. Barclays is likely to benefit from buoyant investment banking activity. Investors hope Royal Bank of Scotland will firm up plans to pay its first dividend in a decade. And they'll be watching Lloyds Banking Group on Wednesday for a potential share buyback. But despite all the positive noise we're expected to hear this week, a quick glance at the bank's share prices suggests things aren't quite as rosy as they might seem.
The reason that the investors are becoming cautious on the sector is because of worries about things like Brexit, which is less than 9 months away now, and the impact that could have on the British economy. There's also concerns about the stability of the political system in Britain. Could we see a Jeremy Corbyn government, a socialist government coming into Britain, which would be pretty negative for the banks? And then finally, there's the overall geopolitical macroeconomic conditions, which are quite positive, with trade growing and the global economy doing well. But with all this rhetoric and talk about potential trade war and US President Donald Trump threatening to impose tariffs on imports, that investors worry could hit global growth and therefore have a negative knock-on effect on the British banks.
And finally, to the Bank of England, which is widely expected to raise interest rates on Thursday from the record lows they were cut to following the global financial crisis. Investors expect the Monetary Policy Committee to vote to raise the main policy rate from 0.5% to 0.75%. This will be the highest that interest rates have been in the UK since 2009. The rate decision will be accompanied by the central bank's inflation report, which sets out its current forecasts for the future of the UK economy. And the Bank of England's governor, Mark Carney, will also give a press conference following the announcement. Financial markets will be watching that closely.
While markets do expect interest rates to rise, it follows a run of weak data, so they'll also be looking to see how the central bank interprets that, whether they think that was just a temporary weak patch following a rebound in the second quarter. We've got 2 more meetings in September and November before the Brexit negotiations are expected to wrap up, and they'll be looking for any signal about how the central bank understands those meetings and what impact they may have on monetary policy in the future.
And that's what the week ahead looks like from the Financial Times in London.